today we're going to talk about trading strategies and using some popular technical indicators that help you in order to create the best strategy and something that will be the most suitable for you as a trader, and that will be also the most profitable. There are plenty of trading strategies, as many as there are numbers of traders. I think there is also a huge number of trading strategies, but it's important for you as a trader to examine the market, to see all the movements, study the movements, and choose something that will be unique, that will be the most suitable for you. And I prefer always to create something on your own. You can use the existing ones from other traders, from market commentators and analysts, but it's good to give your own touch to this, to basically tailor it according to your needs. So you will be the master of that strategy, and then you will know exactly how to handle all the in and out points, all the, let's call them secrets. It will be something yours as your product, and you will know how to handle it. So not necessarily that it has to be done from the beginning. Good practice is always required, so you can use existing strategies. There is a huge number according to your preferences, according to your funds, to your risk management, money management. So number of limiting factors could filter the right one and lead you towards the best strategy that will help you in order to make some reasonable profits in the market. As I said, your own strategy will be something that will come at the end once you gain experience, you gain knowledge about market movements. Then you will be able to examine the market in a right way and create something that will be your own product and will be the most suitable for you. So we'll start with choosing the strategy, with analyzing the market, and then seeing how to use certain technical indicators in order to assist in these things. I think might sound complicated, but it's simple. Whatever we're going to say today, we have already covered in our previous classes, so we're going to just combine knowledge from the previous lessons to see how it works in practice. So until now we're talking about theory. Now we are going to try to compose something out of all the points that we covered, all the subjects we covered in the previous classes, and to get good results at the end. So when creating your own strategy, of course, as I said from the beginning, requires greater knowledge. So it's good that you practice at the beginning on existing ones. You study the market, the price action, and this will help you to gain some extra knowledge, some more experience in the market, learning about how the market functions, how it moves, what are the rules of the market. All these factors will help you at the end to design your own strategy, which will be the most suitable for you. As a strategy, as I said at the beginning, there are a number of strategies, but none of them could give identical results, because most of traders actually all traders have their own preferences. Everyone gives a touch to the existing strategy, or simply adjust the strategy according to his needs or possibilities. So the same strategy will, if you apply it on a $1,000 account or $1 million account, will give you different results, because risk management with 1 million is different, and the trader most likely would allow for a deeper negative balance until reaching his target, while smaller accounts are always limited, and the traders are trying to minimize. Of course, the big traders also try to minimize losses or some negative price entering the negative territory, but sometimes this is inevitable. So every trader has its own preferences and its own needs and its own way of trading. So trade this, no matter that some trading strategies could apply to all trading accounts, there will be the results will be different at the end because of the different factors that we mentioned right now. So once you develop your own strategy, you will be more into this. You will know how it is working, all its secrets, and you will also be able to spot immediately any weak point and work on it to fix it. So the strategy will be more advanced every time you realize that there is something that could slow down your movements, or it's simply a wrong estimation that could result in some negative outcome. You'll be able to fix the problem and improve your strategy. Even when you when you use other strategies, what I mentioned from the beginning, of course, you need to test it first to see whether it's workable with you or not, because we're all different and they all have different needs, preferences, way of trading. So you need to test it, and then again, what we said, to adjust it according to your needs and preferences, basically to tailor it for you. How to create the trading strategy? First of all, it's the best thing is continue studying the market. It's a good thing to sit and choose certain instruments on different time frames and see their movements, their behavior, how they react on certain events, how they react on technical signals, whether they are breaking through some important technical points or not, how they behave when important releases are out, because we have different reactions on the different instruments depending on the number of factors. So once you study this, then you will have more knowledge about chosen financial instruments. It's also important to see larger time frames. Check the previous movements that you can spot opportunities that were already built, that already appeared in the market. So as we said, the market moves in a cyclical way. It's likely that we're going to see again these levels and similar patterns. So it's important to recognize these patterns and be able to benefit from them. So these are the things that you need to watch, and once you learn how to recognize opportunities, you are already on the way to start creating your own trading strategy. It is something similar with the trading analyst jobs. They learn and practice during the time, so they can spot any pattern in the chart, any movement, any bigger or smaller candle, any type of candle that it has some significance, and realize what will be the effect of this candle. And they can always, that's what they do, inform the traders that something is developing. Let's say there was a doji on the chart, or there is outside day, bullish, bearish, various patterns. So they are able to spot. This comes with the experience. So more experience you have, more study you make, better knowledge you will have about all this. And it's also important to build your own confidence in the market, because psychology is another important point that should not be avoided. It's not the subject of today's class, but it's important because trader psychology is different, and there could be a destructive element in case the trader has a strong fear, it's nervous, thinking a negative way, meaning that all the time thinks how I'm going to lose money or something. That distracts him from a main idea of creating profit. So certain things need to be adjusted, and this comes with the experience, with the knowledge about market movements, market rules, reactions. And the more experienced trader has more knowledge, he has feels more confident and has a bigger opportunity to make some profits rather than being in the negative territory all the time. First of all, you have to check the trading advices. There are plenty of such things in the market circulating. There are a number of analysts, commentators, traders who are trying either to sell their ideas or simply to pass their ideas to the others. It's a simple way when a trader comes and says, I'm buying dollar against Japanese yen, and the number of followers, and he has number of followers, meaning that all these people will follow him and buy dollar, so it will automatically boost the dollar yen price, and he will take his profit until the others reach the levels, because he already most likely bought the pair and then suggested. So there are certain things and secrets in the market that you also need to know how the market moves. So it's also recommended to read the news, to read the comments about market, what big traders are doing, how they behave, stories from the big traders. We learned something about this in the last week's class about contrarian theory, when we realized that some of the biggest names in the market made money in just going opposite the market. Despite we learned through our classes that trend following is the safest and the most recommended way of trading, there are people that can afford increased risk and make the fortune on this opposite direction trading. So it's always recommended to learn these things and read these things to learn more about market movements. That will at the end give a good result in creating your trading strategy. Once you start creating strategy, it's good and it's recommended to test it first on demo account. It's quite risky to use the real money for testing. So see, is it workable on demo account? It might not work. It might not be suitable for you, or it might not be suitable for the chosen market conditions, financial instrument, and so on. So it's recommended to test it first, see if it's workable. Then you can proceed with certain modifications that you will spot during the testing, or if it's not, then you just abandon it and look for other opportunities. It's also important to create your own formula for success. So you decide what you want to do and how you want to do it, and stick to this. So this will be continuously improving your knowledge, your trading skills, as well as confidence, as one of the most important points in trading that each trader must have. Otherwise, without confidence, not just in trading but generally in life, there are a lot of things could go wrong, and this is again something to do with psychology, so we are not going to further elaborate. And also it's important to be the realistic, so you can estimate what basically you can see what is your size of your account, how much money you have, what are your possibilities as a trader. Are you beginner? Are you some sort of trader who has some experience, or you're advanced, or you're professional? So based on this, you can build your strategy. Always it's recommended to following trend, follow something that works. Idea or strategy or trend or whatever that works. Do not try to reinvent the wheel or something like this, because most of the times this will end up in unexpected losses situation where you will not be able to handle it, and then it will be just creating troubles rather than joy when you make a profit. And believe me, it's quite nice feeling once you complete your trade and you see that your strategy is working. You were right in predicting market movements, you caught the right move, and at the end when you see the size of the amount that you gained in your account, it's something that greatly boosts your self-confidence. You as a person, you are aware that you are a good trader, that of course mistakes happen, but it's a good thing. It's something that could help, will not create you problem. So what I was saying, it's important to improve your knowledge in by learning from various sources. As I said previously, you have a number of trading advices, comments, technical analysis. That could be of great help, because more you read about these things, and of course by using chart, it's important that you use the chart. And if you read the comment or technical analysis or forecast, then you can realize what the analyst wanted to say. So once you learn this, to be able to recognize his point, that's good. That you are a step further in recognizing things and being on the right track to uh, create more profits in your accounts. So it's quite recommended to follow these things, read them, and learn from them. Always consider that those who are writing and publishing comments, analysis, trading advices, sharing their experience, are usually more experienced and definitely have more trades behind them than you, and for sure more successful. So it's good to learn. It's good to learn from the best ones. I was always following this. So if you have someone who is good and successful, it's good, not just in trading. Particularly, we are talking now about trading, but generally in the life, it's always good to learn from the best, because the results are always going to be good, very good, or excellent. So you study their strategies, see how they act in certain market situations. What do they follow? What attracts them? Trading style, aggressiveness in the market. Remember that each trader is different in approach, in way of trading. Some are very aggressive, some are mild, some are cautious traders, some will never go against the trend, some will be contrarians and going always against the trend. So these things are important to study, to recognize, to spot, and then get something good from this in order to learn and improve your experience, your knowledge, and to gain, of course, self-confidence, which is they are very important. Important is also to mention you learn from them. You try to recognize what is the best from these advices, but never follow blindly. This could lead you to some unwanted situations. However, you need to test their recommendations, see if they work. So this is what we spoke previously. Once you read certain comment or trading advice, then you put it on your demo account and see if it works. Test it several times before you are sure, because if you just get something and follow blindly, it might be successful, but also might lead to losses, and then you will have a problem to recover those losses. And this is another story when traders get hooked into the mud of recovery after the loss, and this usually triggers more losses. So try always to skip recovery action. Strategies also include risk management, money management. So play according to your needs, your preferences, and of course to the size of your account in order to avoid unwanted situations when you will get deeply in red and then trying to recover. And believe me, this will end up with a total disaster situation. Very few traders were lucky, I would say mainly lucky rather than experienced or something, to recover from the big losses entered by, this is could be called human stupidity and stubbornness. So it's better to learn properly, test the strategy, and then of course design it according to your needs and possibilities. Anything above or below it would not give optimal results. So it's the best to do everything according to the current situation, whether in your account or your knowledge, your preferences. that will result in the positive results in your trading account. It's important to watch both technical and fundamental analysis, because they combined, again, back to the one of the previous classes, combining both type of analysis will give you the best results. Technical indicators, technical analysis, they could give you a good signal of technical market direction, will give you good entry points, signals for entry points, factors that heavily involve, heavily affect the market, reaction of the market, as market mainly moves on the demand and offer factor, and this will be one part of the whole story. The other part is technical part. We covered this in one of our previous lessons. It's very important and has strong impact on markets. Any financial instrument will react. So it's important to study both things. Once you open your chart, you take a look, see, define the trend, see how the indicators are behaving, what do they point, which direction they point, are the conditions overbought or oversold, is there any signal of reversal or bounce, any patterns forming that could be signaling again reversal, double top, double bottom, something triangle, whatever. But on the other side, then you have to study fundamentals, because this is very important. A good sample is nowadays story with the Brexit. Brexit is #1 driver of British pound, and anything released with that subject, related to this subject, has a great impact on the behavior of sterling pound against its major counterparts. So we witnessed in past few days, as the turmoil about final exit of the Britain from the UK is approaching, the turmoil increases. Basically, the volatility in the market around the British pound is at the highest levels since 2016 Brexit vote. And these things are very important to be spotted, to learn when they will happen, to see all opportunities, what are the expectations, what are the previous levels, if we talk about economic indicators, and how it will affect the market in a situation that comes according to the forecast, above the forecast, well above forecast, or opposite if it disappoints and comes below forecast or well below forecast. So these things have a great impact. So it's important to follow these news, to be informed. Technical calendars are one of the key tools in this, plus the websites which provide the financial news from the financial world, so you can get all this type of news. So if you have any release from a governmental or semi-governmental agencies that follow the, let's say, growth of the economy of certain country, and they release these things, usually it's released monthly or quarterly, you can see how the GDP of one country was moving in, let's say, past 3 months. So that will be a good signal for the local currency. If it, let's say, falls below expectations, meaning that economy is slowing down, and meaning that the currency of that country will most likely go lower. Now we have central banks, variety of their tasks, what they do, and it's important to follow their comments regarding the monetary policy, the inflation, interest rates, all these things that also heavily affect the behavior of the currency of the chosen country. So it's very important. Nowadays we are facing another signs and warning of a global economy slowdown. So a crisis from 2008 has just finished, and there are threats that another one could be developing according to the signals from the fundamental news. The latest one was last night released from China, that industrial production greatly slowed down. It came to the lowest growth in 17 years. So this is a warning signal that has strong indication that something is going good or bad. Doesn't matter in which direction, but also affects heavily markets. And in the reaction, commodity currencies, all those that are related to Chinese market have come under the pressure. Australian dollar was down. US dollar went higher. Then there was another story about talks between the top US and Chinese officials on the current long-lasting talks about trading issue between United States and China, and possible imposing of importing tariffs from both sides, which is by nature very negative signal. And if this happens, then definitely that there will be stronger turmoil in the market. So two leaders are trying to skip this. There are talks for past couple of months. Now today's latest news saying that the meeting scheduled in this month will be postponed minimum to April. So meaning that situation remains vulnerable and the market doesn't like such a thing. So a reaction came immediately after announcing this. Again, some currencies were heavily down based on these negative tones, negative news from China and from the US-Chinese talks. So all these things are very important to be followed as combination of technical and fundamental tools will give us the best result. So just to go quickly through what we spoke until now, we said that you need to study the market well, study the market movements to know exactly where the market is for the certain instrument. What were the recent movements? What were the longer term movements? What's the trend of the US dollar against Japanese yen, let's say, or what's the trend of British pound in the short term? What is the longer term trend? So these things are important. Then you can see the behavior of financial instruments according upon release of certain fundamental news that are important and how the markets react. Sometimes it's positive, sometimes it's negative reaction, but all these need to be considered and they need to be added to your trading strategy. So you have first thing is to find something that is the most suitable to you, to your preferences, to your trading risk, money risk policy, to the size of your trading account, which is also very important. As we mentioned, the bigger size of the account always gives you more room and more freedom to speculate, to take some more risks, while tighter conditions are always keeping our hands tighten and we cannot react properly even if we want. But of course, you build trading strategy based on your preferences and your possibilities. So these are the factors that are key points of creating strategy. So if you have $500 in the account, then you will say, I'm going to create the strategy based on the current situation. I cannot create strategy like I'm having $500,000 in the account. So these things need to be all taken into consideration. And as we said, a lot of studying market, studying movements, recognizing the previous movements and previous signals, which would likely repeat again. So to see how long they are, how strong they were, and how big opportunity was that if you kind of miss it in the certain period of time, in the certain period when you were trading, let's say on the other strategy, and simply miss this. So most of these things are important that will give you more clear picture about your future trading, and will help you in creating your optimal trading strategy. So what you need also to know is first to decide what you want. First thing, that's what we studied in our previous sessions, is to to check the general direction of the market. Once you have general direction, then you can go split it, break it into pieces, let's say, and you can get more details about this. You can simply create a better environment for your trading. So first thing is to learn where the market is currently, and what is the general direction of the market. So we learned at the beginning that first thing is that we need to learn about general direction, the trend. The second thing is once you have a trend defined, then you have to consider the theory trend is your friend. So once you recognize that trend, then you should be able to start building your strategy accordingly, and will be easier for you to adjust it according to the current market situation. So we can say that first thing is, do you want to see the market direction? Yes, this is important thing, and we need to check it and to know what is exactly the market direction. The second thing is, do you look for entry points? So you will need to calculate these entry points based on the signals that you have, and then do you look for trading signals? Again, the point will be yes. So you need to combine certain technical indicators in order to help you. Of course, in addition to the previous knowledge that you already have on possible movements according to the release of fundamental news, comments, economic indicators that all have a strong impact on the market, and could greatly help you in making a decision. And then you have to identify the type of the market, so use technical indicators, trend lines to determine it. So this is what we talked about. Strategies are different in the different market environment. So if you have trending market, strategy will be different from the one when there is range trading or sideways market. And then you need to identify this character of the market. You need to be sure in which direction market moves, whether it's a larger trend up or down, doesn't matter. Or it's range trading, and adjust your trading preferences according to the situation in the market. Then you determine the time frame, the period of trade. So depending what type of trader you are, if you are an intraday trader or short-term trader, scalpers, let's say, these are the traders that are quickly in and out during the session. So definitely you'll be using some smaller time frames, probably 5 minutes, 15 minutes, up to 1 hour. Of course, you can always use the larger time frames in order to see the general direction of the market, and to be able to recognize what is the general trend. Maybe you are in the middle of correction of the larger uptrend, let's say, and you are trying to sell to catch that correction. Then you will have some limiting points that you will learn from the larger time frames, where the situation may become much more dangerous for you, and then you have to adjust your stop loss and take profit orders in order to avoid any stronger and bigger risk. So in and out. For longer term traders, they'll be using a 4-hour daily, weekly chart in order to spot the trend and just follow it. Of course, corrections will be used as bottoms or corrections, let's say, on the uptrend or tops of the corrections on the downtrend will be used as entry points, and that will be a good signal for the trader when to enter the market and until when we'll be able to stay. So let's try to take a look how it practically looks in the chart. Now we have the chart of British pound against US dollar, quite volatile trading in the past couple of weeks. Trend is generally up. So what we're going to do, we're going to create one trend line that shows us the trend is up. Now, the next leg higher, we can again do the trend line. So meaning that this uptrend is accelerating further up. We can see that moves are steep, corrections are also long. We have big moves, big intraday moves lately. This is due to the volatility that I already spoke about due to the Brexit situation and increased uncertainty. What will be the final outcome of the Brexit as the due date of divorce, which is set for 29th of March. So in 2 weeks it's approaching and the deal hasn't been found yet. Both sides are firmly standing at their positions. Britain and the European Union. European Union gave some concessions to the UK 2 days ago, but obviously that was not enough for the UK Parliament to verify the plan, so they stayed without plan. So the reaction of the market are these long candles in both colors. For example, yesterday's move was around 1.6–1.7% advance, the biggest one-day gains since I think June 2018. So we're talking about something multi-month action, as the price action remains highly volatile on uncertainty what will happen. So this is good opportunity for traders. If we break this move yesterday into smaller pieces, then we can see that there were plenty of opportunities within this move. So let's go back to daily. So yesterday's low was 130.61. So if we go back to the hourly, so it will be somewhere here. This is the one. So we are going from here up. So we had one leg higher, some consolidation, then second leg, then a bit of correction, then third leg, then deeper correction. So we can spot these things on the lower time frames and spot the opportunity to jump in. Of course, we use a number of technical tools in order to help us to recognize these opportunities and to benefit from them. So if we take some technical analysis, then we can always have a better picture of what is going on, and we'll have more signals. So in this case, on the hourly chart, we had the move from here 130.61 precisely here. So we had a cross of 10 days moving average above 20 days and 55 days on the hourly chart. So it was a bullish signal. And if we see that rising 10 days moving average was closely tracking this advance, while the 20 days moving average followed. And then we had the negative signal on break below 10 days and eventually break below both of them with the bearish cross of 10–20 days simple moving averages, again giving negative signal. Now the point is that the market has recovered today after dipping down to 132.07. And this is again due to the high volatility. So this has to be considered because these moves are quite sudden and I would say sometimes unexpected until the news are released. So if the technicals are pointing at something, the fundamentals may come and just cancel these signal and say, okay, now there are different conditions, so the market will react different way. But generally, if we take a look at the daily chart, and then put a set of daily indicators, then we can see that the picture is more positive. We can draw the trend line of the last leg, or we can make it even longer period of time that we did on the first one. So we have a strong bull trend in this case, with its big corrections, but it's going. Now further up, we're going to see what levels have been reached so far. So then we can use the Fibonacci retracement levels of the entire move from 2018 peak in April down to 2019 low, 123.97, and then we can see that previous highs have been taken out. The price action is pressing 50% retracement, so halfway of the entire move. So these are all positive signals. Now we can see that all the moving averages are in the bullish setup, and it gives a signal that trend is up. Now there is hesitation here after the price breached the previous 2019 high at 133.49. Brief move was yesterday to 133.81. This is multi-month high, but the market is hesitating. Market is basically awaiting for more news about Brexit. Bulls remain quite strong on the daily chart. We can see this number of bull crosses of the moving averages. The latest one was 5 over 10 days moving average, two fastest moving averages in the chart. So it's giving us still positive signals, but we have to point at momentum, which is slowing down. Slow stochastic is also slowing down, so we'll be looking for something as opportunity somewhere above these 10 days moving average in order to get the proper signal and for final push higher. Technicals are supportive, so any move lower would be seen as positioning for the further upside. We have the key supports, 200 days moving average trend line, and this higher low at 129.60, which are our breaking points. And in case the market goes below them, then the trend, near-term trend on the bullish signals will be sidelined, and then we'll be looking for short-term down moves. So we need to change our strategy. So these are the things that we need to know about trading. Let's go back to our chart, to our main screen, just to see our chart. Pardon. So you need to choose the technical tool. Few of them will give the best opportunity. These are my preferences, what you have seen on the screen, and each trader has his own, but generally some things, I think we spoke about this on the previous sessions, each trader has its own preferred combination of trading of the technical indicators, but some of them are very popular, and most of traders use them. The set that you saw on the chart previously is one of the most popular, and this gives us quite good and reliable information in any situation. We can add some other things. So sample is that you go to for support and resistance. Then you draw the trend lines, follow the momentum. You can use gun fund. This is something that we covered in two sessions before today's one. Moving averages, you can add Fibonacci retracement, you can use Ichimoku studies, all these tools that we have already covered in our previous classes. So let's go back to the chart and see how it works. So we use the trend line. So trend line gives us support and resistance. So we have the strong support, trend line support. It will show us here at 130.04. So around 130. It's reinforced by this 200 days moving average, which is few ticks below. So we have strong support here. Above this is quite far, and this is our break point. We'll be going for next support. Let's say today's low, the spike low, is at 132.07. So this is our first support since the market hit this level and quickly bounced back. So meaning that there is a headwind strong here, and the support is respectable. So it would likely hold on the next attack unless something happens and pushes the market just quickly through this. The next one is 10 days moving average, currently in the sideways, but reinforced by bull cross of 5-10 simple moving averages. So it gives us another significant support, and this support is around 131. 70 zone. Let's say it's 67.73, so around 130, 170, and this is our first pivotal point, which should not be broken in order to keep immediate bullish stance on the latest up leg from 129.60, which was the low of Monday. High volatility in the market, bullish signal on brief break above previous high. It gives us all information that something is developing. That trend is still bullish, so we'll be adjusting our needs according to the market situation. Market conditions are currently bullish, but we can go back to the hourly chart to see what are the what is the current situation on the lower time frame. So momentum is strengthening, which is good signal. Stochastic is pointing higher, RSI is pointing higher. All of them created bull crosses with their 7 days moving averages. So we have positive signals. Moving averages are again in the positive setup since the price bounced again back above them. They are converging. So, but all of them pointing higher. So we have a positive signal from this side. We can also consult, let's say, Ichimoku studies to see what do they say. Let's put daily. Daily cloud is thickening and is increasing, so it's supporting, it's boosting the advance, but the other thing is weekly cloud, which is hanging above, and the market penetrated again after false break 2 weeks ago, and the failure last week, which resulted in this red candle. This was the initially negative signal, but recent developments regarding Brexit and the situation in the UK over the divorce with the European Union obviously worked in favor of sterling and improved the sentiment after this double failure here and pushed the price higher. We'll be watching, let's say, tomorrow's weekly close. If it occurs above the cloud base, that will be another positive signal. And of course, then we can use Fibonacci retracement levels and see what we have. We have 133.686, 50% midpoint, important level. And then we have weekly cloud top, which is at 35.19. It's not far from here. So in case the price accelerates, if the situation further improves and the sentiment improves in the UK regarding Brexit, as we know that UK Parliament last night voted for no deal divorce, so they require that any divorce must be accompanied with a deal, with agreement between two sides. So investors regain the courage, let's say, regain the positive tone, as at the moment immediate fears and risk of disorderly Brexit, which was the nightmare for most of the traders and people from UK, is now sidelined. So we're looking for possibilities after this, and these are basically going to be main drivers of the British pound in the coming days. 21st of March is the Eurogroup meeting when there'll be final decision. Meantime, there is strong expectation. There are strong expectations in the market that existing divorce plan of UK Prime Minister Theresa May will be eventually accepted by the Parliament in days before 21st of March. So it will add another positive moment to the current sterling movements, and will help this bull trend to extend further up. Now, what else we have We can also use let's go back to the momentum studies. We didn't talk about this, and we mentioned it. So 14 days momentum is one of the preferred. 14 or 10 or 22 days are preferred time frames to be used. In this case, we have 14 days, so momentum is a bit lower, though it's positive. Momentum is bullish. It's above this midline and it's pointing higher. And now we have market hesitation at previous high since it was cracked, but failed to close above this and generate bullish signal. So momentum is still strong, but pointing lower. Identical situation is with the slow stochastic as well as relative strength index. So what we can expect in this case is extended consolidation, probably with some dips before the market moves higher in the current market conditions, unless some news come out meantime and just make a mess in the market, like it happened yesterday, like it happened on Monday. So there are plenty of events that are nowadays coming out regarding Brexit news, decisions that heavily affect the market. So we have to be aware of this and follow it. So basically, when we build our trading strategy, we realize that market is in uptrend, that market is well supported for now, that market has breached some points, and then we'll be moving to the gun studies. Recall the last 2 weeks ago we spoke about this, and basically it measures the speed of gains of the given financial instrument over the period of time. There is a baseline of 45 degrees, and then actually these are not well positioned, so we'll move them. So what does this mean? That all lines left from the or above our center line 45 degrees are showing a faster price increase with the during the lower period of time. So 2 units of the increase of the price was done during the one period of time, and the more steep is this line, the faster the price raises. We can see that sterling jumped well above 45 degrees line and then dropped down, and now is returning back to 2-to-1 line, which is the next one from the 45 degrees line, meaning that the price action in case of breach will gain 1 unit of price for 2 units of time. But it seems that it's speeding up, and break above here will be quite a good signal that the sterling could extend further up. Now back again, moving averages. So we covered them, but let's just quickly go. This is a standard setup. Okay, they're a bit more than usual, but they give more information about market movements. So starting with the fastest 5 days moving average, 10 days, 20 days, 30 days, 55 days, 100 days, and 200 days. So behavior of the moving averages, we spoke about this in some of the previous classes, is very important and gives us good signals. So-called bullish setup is when the price is above the moving averages, and all crosses that they make of the faster one above the slower one are called bull crosses, and they are positive signals. So more bull crosses means that the market is accelerating higher. Lately we had this, actually today, the 5-10 bull cross. Last week there was 20-30 moving averages bull cross. So generally they are in a bullish setup and supporting market. Dips are allowed somewhere here above 10 days moving average in order to keep this bullish stance. But again, we need to say no matter how technicals are pointing, we need to check the fundamentals and have a clearer picture. So just to resume all what we spoke today, we're going to talk again about trading strategies. We're going to add some more things we are doing it gradually, so I don't want to overload you with a lot of things in one lesson. But generally, idea is to study the market, see what is the market direction, market behavior, previous market behavior, and expected behavior in the near future according to the technical analysis and as well as fundamentals. Two very important factors that none of them should be ignored or missed, because missing one will for sure lead you to some situations that you will get stuck because of lacking information that something is happening. So you need to combine technical and fundamental tools in order to have the best information, the most reliable information that would at the end result in the good profits in your trading.